So, you want to be a real estate investor, but where do you start? How do you know what information and sources to trust? That's where I come in. I'm Jonny Cattani, and this is the Investor Relations Real Estate Podcast. Hey guys, real quick, before we start, go to investwithcattani.com and download my free ebook, Is Commercial Real Estate Recession Proof? Now to today's show. What's up, guys, and welcome to another episode of the Investor Relations Real Estate Podcast. I'm your host, Jonny Cattani, and I am joined today by Bernard Reisz. Bernard is CEO and Chief Education Officer at ReSureFinancial.com and members.ReSureFinancial.com, delivering self-directed investor tax and financial tools for alternative investing using complete control IRAs, QRPs, solo 401ks, 1031 exchange services. ReSure also provides objective advisory services for QRP, SDIRA, UBIT, UBTI, UDFI, 1031, LLCs, entity structuring, installment sales, and cost segregation, helping real estate investors navigate all these expertly and integratively. That's a lot of letters, Bernard. Welcome to the show.
Great to be here, and hopefully over the next half hour or 45 minutes or so, we'll break down what all those letters stand for, and why they're important to investors, because you got to know about the stuff. If you're an investor or you're in investor relations, this is key stuff.
Absolutely. And before we kind of get into it, I know that this is one thing I'm sure you can speak to is kind of coming into more light in terms of being a useful tool in investing in alternative assets. I was a stockbroker for a long time, and not very many people knew that this was available to them. So definitely excited to talk about it. But before we get into the weeds, kind of give us, high level, how you even got into this industry.
So more than anything, I'd say my background is kind of being a scholar. And that's why, first and foremost, today, I like to say Chief Education Officer. That's really what it's about. It's about just learning, studying, and educating. Real estate has incredible tax tools that are available. However, there is more nuance to them than folks often realize. So there's opportunity to actually kind of take these to the next level, and even kind of bring them all together and leverage them collectively, and their combined impact can be even more powerful. But there are also opportunities for missteps that are not put front and center. So that's really what we want to focus on, is in the education, so folks can make well-informed decisions.
Absolutely. I couldn't agree more, especially when it comes to some of these, because, obviously you touched on the tax incentives and things that are available, but when you go down that road, then you're, playing with the IRS, and, you take them on, they win 10 out of 10 times. So it's always good to make sure you have the most education and someone who knows exactly what's going on, which is what it sounds like you fill your time with. So as an investor, I'm grateful that there are those of you like you out there who are willing to learn all of this. So let's kind of get into it. Obviously a ton available in terms of all the different tools that investors have to invest. So kind of talk about let's kind of start in reverse. Let's start with some of the misconceptions and things, and we'll kind of go from there.
Yeah, let's do it. There are a couple of things that I'd see as missteps that I may see in the space. So the first one you've already touched on is folks thinking that, hey, I want to invest in real estate, right? They've come to that realization. They want to invest in an alternative asset. And alternative asset, yes, the most popular and consistent, deliverer of returns, kind of that people have confidence in, has been real estate. There are other things that come and go, right? You can use retirement accounts for merchant cash advance, for cryptocurrency, for an entire array of asset classes. But real estate has kind of been the anchor. So once people have come to realization that, hey, I want to get into alternatives, one of the mistakes is thinking, hey, I can't do this with my retirement accounts. Now that sometimes leads to a secondary mistake, which is, all right, let's raid the retirement accounts. let's empty them. Let's take taxable distributions. So this way we can invest in the stuff that we want to get that Uncle Sam is not letting us get to. So folks got to realize that Uncle Sam is actually is not getting in your way. There is an industry, and I don't even fault them to an extent, because it's not their job to tell you the other things that you can do. Right? There is, I think, the biggest challenge the financial product and tax product industry, that's folks face is thinking that people are advising them, and when in reality, they're selling them stuff. And so when somebody's selling you stuff, it's not their role to tell you about the stuff that you can get at other establishments, right? So I don't even fault them for it necessarily. We really have to make sure we educate ourselves as broadly as possible. That's really what it's about. So folks think, hey, you can't do this. Now, if I would ask you, does a tax code say that an IRA or a 401k can invest in stocks? Can I ask you, Jonah?
Yes.
Does the tax code say you can invest in an IRA or 401k in stocks?
Yes.
So that's kind of true, but the real truth is the tax code is really silent, right? So it doesn't say anything more about investing in stocks than it does about investing in real estate.
Really just says what you can invest in other than that.
Exactly. Collectibles are out. Life insurance is out. Again, each of those is a topic in itself, but those are out. Everything else is in. Now, there are kind of procedural rules that you got to be aware of, and a whole world of compliance and strategy that you get into that doesn't apply if you're investing in stocks, which leads us to another, I guess, error that people make. All right, some people find out, hey, awesome, I can use my retirement accounts to invest in real estate. But that's kind of where it ends. Then they have that epiphany and they think, hey, all right, it's just the exact same thing as having a brokerage account at Fidelity, except it's real estate. But the truth is, the tax code that applies to retirement accounts is really, really broad and deep. But if you're only investing in stocks, you only have to know a small sliver of that. It's when you actually get into alternative investments that 95% of the rules that were written for these accounts actually come into play. So once you have that epiphany and you realize, hey, I can do this and I want to do it, you do have to kind of get a little into the weeds to familiarize yourself with the nuances. So that's, I think, leads us to a third kind of, error, we'd say, or misstep. So the first one is emptying the cookie jar. And folks will do that either because they're not aware of the options. Alternatively, they're going to hear about some of the compliance stuff we may talk about and be intimidated by it, or get some misinformation or incomplete information about it and say, you know what, these self-directed retirement accounts are so complex, not worth dealing with them. Let's just take the money out and take a taxable distribution. What do you say, Jonah? How are we doing so far?
Great.
So I think it's helpful to illustrate, what can be so terrible about raiding the cookie jar, but emptying the retirement account. And it also lays the groundwork for really understanding the power of tax strategy. Viewing tax, and I'll explain, because viewing tax strategy as simply, okay, I saved $10,000 this year on my taxes, is actually taking a very narrow view and doesn't capture the full power of tax tools. So when you take your money out, you raid the retirement account, any money that comes out of traditional IRA or traditional 401k is taxed as ordinary income. And it gets stacked. You take all your ordinary income for that year, and this gets stacked right on top of that, very easily getting into top marginal income tax brackets. So even if you may otherwise not be at 37%, right, that distribution may very easily be taxed at 37%. Add to that 10% penalty for an early distribution, you may be at 47%. Now, if you happen to be, which state are you based in, if I may ask?
I'm in Utah.
Okay. So if you don't happen to be in one of the handful of states that have little or no income tax, right? Then we're going to add state income tax on top of that. And if you happen to be in a particularly punishing state, be it California, New York, New Jersey, Rhode Island, right? We're looking at 60%.
Nothing. Now you have nothing left.
Now, what's the impact of that if you're a real estate investor? Let's try to quantify this. So now there are two things before we've been talking about how this works in real estate. When you invest, the true power is the compounding. And you've got to plug it into a spreadsheet in order to see this, because it is so astonishing. Talking about it, it doesn't do it justice, but you can graph it and then you can see if you start with a smaller nest egg, right? And you're paying taxes on that every year, 10 years in, all of a sudden, and compare that to starting with a nest egg that's twice as large and is not getting that annual tax drag. About 10 years in, the gap is it's insane. And with the passage of time, there's an incredible snowball effect. The difference is exponential. And the difference in net wealth is easily hundreds, can over time literally be hundreds of times, easily tens of times greater if you start with a bigger nest egg and you don't have annual tax drag. So not paying taxes is not about saving $10,000 in taxes this year, and paying 50% on your IRA distribution to the IRS is not about giving the IRS $50,000 that year. It's losing the compounding returns on that 50K.
Yep.
That we're talking over decades is millions. So the taxes, it's a mistake to view, one of the biggest misconceptions to view taxes as kind of this, this year, well, how much did I pay this year? Or how much did I not pay? Now let's take this to real estate, and then it gets insane. Every dollar, how much real estate can you buy with $100,000? Right, with $100,000 of cash, do you get $100,000 worth of real estate? You get $400,000.
Yeah.
You get, right? So for every dollar that you give the IRS, you're giving up $4 in real estate, right? Now this is getting insane, right? So if you take that distribution, right, and you're going into real estate, if you gave the IRS $100,000, IRS, state, let's just use 100 grand as a round number, you just gave up $400,000 worth of real estate and the compounding on that. So kind of nuking the retirement account is very hard for that to make that back. It's true, there's complexity and nuance, and there's a lot of incomplete information or sometimes almost deliberate misinformation about some of these topics out there on the web. But it's better go find somebody that's going to give you the straight talk and knows all the moving parts. Don't nuke that retirement account. Don't make missteps with that, because missteps are costly. That's the downside. But the upside is the absolute converse. Smart moves, get greatly rewarded. And to bring this to like a 1031 exchange, right? We do 1031 exchanges as well. It's the same thing. Sometimes folks say, again, 1031 exchange is not always the right thing to do. But just to give it the right context, it's not like, okay, am I going to pay $100,000 on this, right? If you don't pay that $100,000, you get to buy another $400,000 worth of real estate, right? So it's not about that tax bill. It's about how much real estate are you going to have, right? And you know that if say you had a deal where you started with $500,000 and now at the exit, you're selling for $1 million, right? If you don't pay taxes and you keep growing your equity, right? Then you can remember that leverage, you're getting right? You're going to get to buy, again, lever that up 3-to-1. That's where the real power is. It's not about this year's tax bill. It's about decades of compounding and getting and leverage.
Wow. That was very, very well put, and something that, sort of an angle that not a lot of people talk about, right? Because, again, like you mentioned and alluded to, people want to nuke their retirement accounts because they want the money now and don't want to deal with it. But again, let's say $100,000, you give 60% to, Uncle Sam, you're below most minimums now, right? So now you have $40,000 if you want to get into syndications where you're below the minimum. And there's another $60,000 of compounding funds that are gone. So now kind of talk about, we didn't nuke it. We have it available in our retirement account, and what now we can do with that and grow and take advantage of these things.
Yeah. So this is exciting stuff. Hopefully we'll hit the high points, and let's try to illuminate the space, a space that is, there's a lot of oversimplification. Now there are many, many, many types of retirement accounts out there. There are theoretically like an almost infinite number of structures. So we need to simplify and define, and there are different terms. Some terms are like scientifically defined in the sense the tax code tells us what they mean. Then there are other terms that are used as marketing terms, and marketing terms are sometimes designed to convey helpful information. They're like, hey, let's skip the jargon. Let's use some terminology that kind of captures all that and expresses it in a way that people can understand. But sometimes marketing terminology can be designed to obfuscate and deliberately almost cloud things. So let's try to define terms. Definitions, I think, is a great, awesome place to start.
Absolutely.
So there are retirement accounts can be categorized in many ways. Like we have different ways, like a matrix. We can define them during different parameters. So one thing is, one way to define them is talk about qualified retirement plans versus IRAs. So that's qualified retirement plans. And if we break them down to their essence, are plans that have a trust that is holding assets for the benefit of employees, right? So essentially there's a single trust that is holding assets for a group of people, right? A group of participants. And we define that group, right, as the employees. Those are qualified retirement plans. And most Americans are familiar with qualified retirement plans. They may not have heard that term, but the most pervasive retirement account today is a 401k, and a 401k is a qualified retirement plan. Easy to say, qualified retirement plan is quite a mouthful. So we're just going to abbreviate that and say QRP, all right? Just to simplify, just like nobody says individual retirement account. Yeah. Did you contribute to your individual retirement account this year? My CPA called me and said, it's April 15th, put money in your individual retirement account. And you'd be like, what's an individual retirement account? Right? We all say IRA.
I wonder how many people know that IRA stands for individual retirement account too, on the other side of that.
Yeah, exactly. Right. So we say IRA, and that is really the key distinction. IRAs are individual. Every IRA is a trust. Every IRA is just about, but we're going to keep it simple. Every IRA is a trust, just like every QRP is a trust. It's just the QRP is kind of like a collective, a group trust. And an IRA is an individual trust. So, and sometimes folks say trust to make it sound like, hey, this is a trust, sophisticated, savvy. They're all trusts.
Right.
So, and in fact, all I can't do is screen share. But if we look at IRAs, right, the first section of the code that introduces IRAs defines it as a trust established for the benefit of individual. Mm-hmm. And if we look at the section of the code that talks about QRPs, the first paragraph defines it a trust created by an employer for the benefit of employees. So now each of these accounts have many different, I'll call them substructures, that fall under that rubric. So qualified retirement plans do include defined benefit plans, cash balance plans, profit sharing plans. People used to hear about KEO plans, but that's essentially just a profit sharing plan. And each of these have a lot of flexibility in their design. We help folks use all of these for real estate. However, there is a lot more flexibility and complexity to QRPs. So the sweet space to be for QRP is ideally to have a solo QRP. Now, what is a solo QRP, right? It can be a solo 401k. It can be a solo defined benefit plan. It can be a combo of those, right? It can be any of these. But what makes it solo? What makes it solo is that the only eligible participants are the business owner or owners and their spouses. And this is where we see a lot of mistakes. So what determines who's an eligible participant? There are a lot of folks that say, hey, I just don't give it to anybody. I have a QRP, right? Most part, we know that there are errors lurking. If somebody doesn't know what type of plan they have and they use a generic term, like somebody's QRP is just such an umbrella term that it's not defined, right? Undefined, it doesn't tell folks, and folks have no idea what kind of plan they have. There's no way they can be compliant. There's no way they have any awareness of the compliance questions. So some folks say, hey, yeah, I just don't give it to my employees. That is like the cardinal sin of QRPs, is not to give it to employees. So if you discriminate, right, it's a group trust and is created as employee benefits. If somebody doesn't give it to the employees that are otherwise eligible, and there are tax rules, and if folks actually read their QRP plan documents, right, 120 pages, they have all the non-discrimination rules in there, right? So if somebody does not give it to their employees, the plan can either be disqualified, or there are very, very costly corrective measures. Now, then you find folks that say, oh yeah, I don't want to use my employees, but I'm going to just create a side LLC. That does not work. And then folks, there are a whole lot of stuff out there. Essentially, the IRS and the Department of Labor have a very complex set of tools called control group rules, affiliated services group rules, and family attribution rules that are in place precisely because 60 years ago, folks tried playing these kind of games, structuring things so that they don't have to. It doesn't apply only to retirement accounts, right? But structuring things in a way that, hey, we can defeat Uncle Sam by creating a new entity, right? And then the Congress created some new rules. Folks got a little smarter, said, hey, yeah, but we can do it this way. Congress introduced another layer of rules. This stuff is around for decades. So by now we have a very, very well-developed set of rules that make it very difficult for a business owner not to offer a qualified retirement plan to employees. So if somebody is truly solo, you get almost all the benefits of a qualified retirement plan without dealing with most of the complexity. So that's a sweet place to be, but folks have to know, hey, which zone are you in? Are you really solo or you're not solo? Now, IRAs are simpler. They don't have kind of all the flexibility that qualified retirement plans have, but simplicity is beautiful, because simplicity means that you don't have to worry about 100 different compliance stuff that you've never heard of. So that's one way of defining it: qualified retirement plans versus IRAs.
Right.
And within qualified retirement plans, ideally the sweet space to be is solo.
Got it. And another big point too is, obviously if you're solo, you're only relying on yourself, and you, like you said, you get all the benefits, but really what it comes down to is you're not relying on an employer. right? It's not some, you know, principal account where you get like 3 different options on how you want to invest, right? Whether you want to be safe, moderate, or speculative, and that's it, you know? Whereas the solo, you obviously get to really choose, and then the IRA, you get complete control of. So,
Yeah, and you can get complete control in all of these. That's the irony of this, right? An IRA, most folks are accustomed to having an IRA being restricted. And most are accustomed to 401k being restricted. You can have employees and have all these options. We help folks with that all the time, right? There are a whole set of rules and complexities and nuance and certain things you got to be aware of, but it is eminently doable even if you have employees. But one of the things the IRS looks out for, you can't only not discriminate with regards to, hey, can you participate in the plan? You're not allowed to discriminate with regards to in industry jargon. And I don't mean self-direct. You're not going to hear this in self-directed industry, but in the true 401k administration space, there's something called BRF. And BRF, I guess we got another acronym there, benefits, rights, and features. So it's not like you can say, hey, I'm the business owner, I am going to invest my 401k account in syndications and crypto. And hey, you employees, you guys don't get to do that, right? That would be discrimination. That would be discriminatory as well. So you got to when you have employees, it just opens up more compliance stuff to be navigated. Whereas if you're really solo and nobody else is eligible, you know, do what you want, more or less.
absolutely. I love that. That's a great point. So I want to get to some of these letters that I haven't heard of. What is UBIT, UBTI, and UDFI?
So UBIT, these are all related concepts. UBIT stands for unrelated business income tax. UBTI, it's going to sound like the identical thing, but there's a difference. Unrelated business taxable income. So one is unrelated business income tax. The other is unrelated business taxable income. And UDFI is unrelated debt financed income. Now, this is where the rubber hits the road. And this is where there is also gotta shed some light on this stuff.
Absolutely.
So all tax sheltered entities can sometimes be taxable. All, without exception. That is QRP, IRA, Red Cross, United Way, your local church, temple, synagogue, whatever it may be. There are certain circumstances in which these can all be taxable. Now, when this ends, so when the tax applies, right, and there's actual tax liability, it's like, hey, pay up, we call that tax unrelated business income tax. But what is the kind of income that can create that tax liability? Right? What's a taxable income? For most people, right, you earn income, it's taxable, right? More or less the way the tax code is written. And this is something that actually a concept that plays a role in a lot of tax controversy. Like more or less it's written that everything is taxable and nothing is deductible unless under the good graces of Congress, they've made it deductible, right? So by default, right, everything is taxable. Congress doesn't really have to tell us, oh, that is taxable. Yeah, if it's income, it's taxable. A deduction works the other way. Congress has to actually tell you this is deductible. If they didn't tell you it's deductible, it's not deductible. If they made a mistake and they're like, oops, we forgot to write that in the code, and the IRS knocks on your door like, hey, this is a business expense. But if it's not in the code as a valid deduction, you don't get it. So for tax sheltered entities, obviously it works a little differently. I'm not saying that that concept doesn't hold true, but generally speaking, they've been exempted from taxes. But if they have unrelated business taxable income, that income would be taxable. So what is that? And how did that get to be? Knowing some of the context is very helpful. In the late 50s, New York University, I believe, was bequeathed ownership of the Mueller Macaroni Company. So now we have a university that is competing, right, in the retail food space. Now, every company, right, how do you price your stuff? How do you earn profit? How do you grow? How do you manage stuff? Well, you got to figure out what your margin is, right? You got to charge a certain price for your product that's going to cover your expenses and hopefully leave something over for profit. Now, what's one of the biggest expenses that every company's got to pay?
Salary.
You got it. And what's the, let's say it's runner up, or in those days, maybe even greater, taxes.
The taxes. Okay.
Right. So part of the purchase price has got to be, right, they got to bump up the price to say, hey, we're going to give a big chunk of this. In those days, tax rates are actually higher than they are today. We're going to have a big chunk of whatever we take in has got to go to taxes. So we got to have prices this high. Well, now we've got a hospital that's selling pasta. They don't have to pay taxes, right? Remember, they're a university hospital. Well, they can sell stuff for 30% less and still be profitable. You know where that ends up.
Right.
Well, NYU would have cornered the market, would have a monopoly on. Now, if Congress had not gotten involved, what that would have led to is essentially all the businesses in the country being owned by hospitals.
Yeah.
Right? Because nobody else could possibly compete with that.
Right.
So what Congress created this rule that if a charitable and if a tax sheltered entity engages in a business activity that is unrelated to its tax exempt purpose, right? So you're a hospital. Of course, you get some revenue from running a hospital. That doesn't become taxable because that's why we want you to do as much of that as possible. That's why we think that's a great cause. That's tax-free to you. But now you're selling pasta that's got nothing to do with being a hospital. Not unrelated for the reason why we made you tax exempt.
Right.
So if you do that, that income is taxable. And that's what we call unrelated to the tax exempt purpose, business taxable income.
Got it. So real quick, touch on a lot of churches seem to still skate by this. How is it that, they're able to skate by some of this stuff? Despite, like, for instance, here, the Mormon church is obviously huge. And over the years, it's become public, some of their business dealings, which are not related to the religion whatsoever, yet somehow it's still untaxable, or they find a way. What kind of speak on that if you can?
Yes. So obviously, just like there's tax strategy for individuals, there's tax strategy for nonprofits. Right. Now, they may be paying tax on some of it, but believe it or not, right, there's a whole industry that caters to that to create what we call blocker entities, as an example, right? So that it doesn't flow through to, right? So large hedge funds have special structures in place so that large pension funds and not-for-profits can invest and not create and not end up with UBIT. So there's tax strategy for everyone, and there's tax strategy for not-for-profits, and retirement accounts is kind of where there's some overlap, right? Because now all of a sudden, every one of us is really running our own little non-for-profit. That's exactly what's going on. So now while a hospital, right, will not have taxable income on its hospital activities because that's its tax exempt purpose, IRAs and QRPs don't have a specific tax exempt purpose, right? It's not like the IRA was formed to create, to provide any particular service or function that Congress said, hey, we want to make tax exempt. Congress said, hey, whatever you do, you're tax exempt. They don't have any particular purpose. Therefore, any trade or business that a QRP or IRA engages in on an ongoing basis has the potential to create UBTI. So this is where you get to the space where folks are either not aware of this at all, right? And they kind of get into the space totally unaware of the fact that you got to navigate this. Alternatively, folks will hear a little bit about the stuff, but they'll get misinformation about it, and that will drive them to making missteps. Either they'll say, hey, let's nuke the account because, hey, there's this UBTI stuff. Let's just run the other way. Alternatively, they may hear that one account structure maybe has some sort of UBTI benefit over the other account structure and say, oh, let's not use this account type. Let's use that account type because that account type is better, doesn't have UBIT. And that's usually incomplete information. So the key thing is to put into perspective the decision-making process for how to use retirement accounts for alternative investments. So I'd say the principles that we run on are in the overwhelming majority of scenarios, nuking the retirement account is going to be a bad move. Number two is the starting point for a discussion about which retirement account structure to use is never UBTI or UBIT or UDFI. You're going to find people saying, hey, never use an IRA because IRA has UBIT, use a 401k because it doesn't have UBIT. Use a QRP, it doesn't have UBIT. So what we have to understand is all these accounts have the potential to have UBIT. There are some limited exemptions for qualified retirement plans, but those are limited exemptions. And those exemptions have exceptions to them.
Of course.
And when UDFI is put in context and a proper perspective, it's not really all that bad. And so, of course, it's better not to pay any tax. But one of the ways to illustrate, and it's okay, can we run a little live experiment here?
Yeah. Yeah, we're running up against time, but yeah, real quick.
So if I were to tell you that you can invest in real estate, all cash, you have 100 grand in your retirement account, all cash, and let's leave syndications out for a moment. And you wouldn't have any UBIT. Or you can use leverage, right? But that's going to create UBIT liability. Would you do the all cash deal and avoid the UBIT? Or would you take the leverage and deal with the UBIT?
It certainly depends on the UBIT percentage, but most likely I would go with the leverage because anytime you can create more debt, you're probably going to make more money.
Yeah, we've got a winner. So the key thing to understand is that two things. The tax is only on the portion of the returns that's generated by the leverage. So your 100K that you put in is never taxable, period. It's only the levered portion. Number two, we're talking about real estate. Since when does real estate have income? Right? You never have income. You have cash flow, but for the first 3-4 years, generally, there is no income. Well, of course, there is income, but from a tax perspective, there is no income. If there is no income, there is no UBIT. Where it comes into play is upon a sale, that it's taxed at a capital gains rate, 20%. Again, it's only the portion that is levered, not your equity. So it's really, it's just not, it's like some folks hide it and some folks make it like the centerpiece of the conversation, and it's neither. It's something to be navigated and understood and optimized for, but it's not the centerpiece.
Wow. That's awesome. That's incredible information. I didn't even know half of this. So that's great to learn. Unfortunately, we are up against time. We'll have to do another episode because clearly we can talk more and more. And this is the stuff that I love to learn about. So I do have 5 questions that I ask all of my guests. It's the final 5 questions. What's the best advice you've gotten from a mentor?
The best advice I'd say is to really get past the superficial. Always look for the substance. In so many areas of life, of course, and we've seen it in kind of the topics we've discussed tonight. This is true in the financial space, but really to take it beyond that and realize there's a lot of superficial stuff out there. And in everything we pursue, let's try to get to the substance and get past the surface.
I love that. That's awesome. What is it about your career that makes you feel like you're fulfilling your why?
Just that commitment and staying true. It's actually something that there was a point where I struggled with it. Because you get to somehow see folks out there that, hey, are not giving in the financial space and the tax product space. There are certainly, right, and I'm guessing in your background as well, there's all types of folks out there. And some of them actually, really put, try to stay on the up and up and up and really put their clients' interest first and give them the best info available. And there are folks that don't do that. And sometimes you can see those folks, hey, selling, and you can grapple with it, but then you realize that that's not what makes me happy, right? You got to be true to yourself, and that's when you feel ultimately fulfilled.
I love that. That's so true. What's your favorite non-real estate or investment related book?
Okay. The series, a book that everybody's got to read. You got to read Nassim Nicholas Taleb. That's a series. I like a lot of probability and statistics stuff, so I can say the whole bunch of books that fall into that kind of category. But if you're going to pick one series, go for Nassim Nicholas Taleb.
Awesome. Love it. If you could have any superpower, what would it be?
I'd say it's really to have that clarity of vision. Sometimes you don't always, you're not sure sometimes, we got to, in life, we have to take action, right? And sometimes we follow our gut. We try to gather as much information as we can and then confidently, step into whatever choice we've made. But it would be nice to someone be able to have that perfect clarity.
To know exactly how a decision is going to turn out. I love that. So true. Cool. And what's the best way for people to get a hold of you and learn more?
Check us out at our website is ReSureFinancial.com. That's RESURE financial.com. But I've really created as kind of more like a passion, an education space. That's members.ReSureFinancial.com. A lot of content there, constantly adding more content on an array of financial topics, obviously heavily real estate tax geared, but there's also life insurance, estate planning, asset protection, all sorts of stuff, but really obviously comprehensive info on QRPs, Sol 401k, Checkbook IRA, 1031, cost segregation. Love to see you there.
Awesome. We will link all of that in the show notes. Bernard, this has been incredible. Thank you so much.
Jonathan, thanks for having me.
Absolutely. Hey guys, thank you so much for watching today's episode. I hope you really enjoyed it. Listen, I know it's cliche and you hear it all the time, but please don't forget to like and subscribe to the channel so you know when the next video is coming out. Even though this is technically a daily podcast, it's coming out the next day. We have a ton of content coming your way. So please like and subscribe. It helps a ton. Leave comments. Would love to know what you guys think. And we will see you on the next one. Thanks so much.